Every month, millions of Americans log into their bank accounts or write a check to pay their 30-year fixed-rate mortgage. It is the financial foundation of the modern middle class, a completely normalized part of adulthood that dictates where we live, how we build wealth, and how we plan for the future. Yet this seemingly natural pillar of homeownership is actually a modern invention. The universally accessible 30-year fixed-rate mortgage did not exist in the United States until the 1930s. This raises an immediate and perplexing question. Before the Great Depression, how did an average family actually afford to buy a house? The answer reveals a forgotten era of extreme financial peril. The creation of the long-term mortgage was not a product of natural free market evolution, but a desperate government intervention to stop the complete collapse of the American banking system. To understand how radically the system was redesigned, we have to examine the brutal reality of buying a home in the 1920s. In the era before federal housing agencies, the concept of paying off a home slowly over 3 decades simply did not compute for a bank. Lenders viewed real estate as highly illiquid and inherently risky collateral. If you wanted to buy a house in 1924, you generally needed to walk into a local commercial bank or a building and loan association with a massive amount of cash. The standard down payment was typically 50% of the property's total purchase price. For most working families, accumulating that much liquid capital was an insurmountable barrier, meaning homeownership was largely restricted to the upper classes, or those who had inherited wealth. But the down payment was only the first hurdle. The loan you received for the remaining 50% looked absolutely nothing like the mortgages of today. Instead of a long-term amortizing loan, banks issued short-term balloon mortgages. The typical term for these loans was exceptionally brief, usually lasting just 3 to 5 years. During those few years, the borrower usually only made payments on the interest of the loan. The principal amount remained entirely untouched, hovering over the household finances like a dark cloud. Then, at the exact end of the 3 or 5 year term, the entire principal balance was due in one massive lump sum. In the financial industry, this was ominously known as a bullet payment. Of course, very few people could actually afford to drop thousands of dollars in cash at the end of 5 years. The system was never realistically designed for them to actually pay off the debt. The expectation, built into the very fabric of the real estate sector, was constant, unending refinancing. When the balloon payment came due, the borrower would simply go back to the bank, pay another round of hefty origination fees, and roll the debt into a brand new 3 to 5 year loan. This cycle repeated continuously throughout a person's life. A homeowner was perpetually in debt, constantly renegotiating terms, and entirely at the mercy of the local bank's willingness to renew the paper. This architecture functioned decently well during periods of extreme economic optimism and easy credit. Throughout the Roaring '20s, property values were rapidly rising, local banks were flush with cash, and refinancing a bullet loan was essentially guaranteed. But this entire housing market was a fragile house of cards built on a catastrophic structural flaw. It relied on the absolute certainty that banking credit would always be cheap and readily available at the exact moment those balloon payments came due. That certainty evaporated in the autumn of 1929. When the stock market crashed, it did not immediately destroy the housing market, but it triggered a chain reaction that would ultimately expose the fatal flaw of the short-term balloon mortgage. The mechanism of destruction was not falling stock prices, but the rapid onset of severe banking panics. As fear gripped the nation, depositors rushed to their local commercial banks and building and loan associations to withdraw their life savings. This created an immediate and catastrophic liquidity crisis. A bank does not keep all of its depositors' money in a vault. It lends that money out to generate returns. When hundreds of people simultaneously demanded their cash, the banks had to find liquid capital immediately or face total collapse. To survive, these local institutions had to call in their debts. They could no longer afford to be generous with credit. For the American homeowner, this macroeconomic panic translated into an intimate, personal disaster. The devastation began quietly in the offices of local bank managers. Imagine a family in 1930. Their 5-year balloon mortgage has just reached its maturity date. Following the established ritual, the homeowner walks into the bank, fully expecting to pay a small fee and sign the paperwork to roll the principal into a new 5-year loan. But this time, the bank manager shakes his head. The bank is bleeding deposits and desperately needs cash to survive the week. They refuse to refinance the loan. The trap of the balloon mortgage is suddenly sprung. The entire principal balance, perhaps thousands of dollars, is due immediately in cash. Because the homeowner had only been paying interest for 5 years, they had built virtually no equity in the property. And because the broader economy was collapsing, they had no way to secure a massive lump sum of cash to satisfy the debt. The bank, legally bound by the mortgage contract and fighting for its own survival, initiates foreclosure. This scenario played out not just hundreds of times, but hundreds of thousands of times. The sheer mechanics of the short-term mortgage system turned a severe economic downturn into an apocalyptic housing crisis. As banks foreclosed on homes, they accumulated a massive inventory of residential real estate. But banks are not in the business of managing empty houses. They needed cash to pay their panicked depositors. So they dumped these foreclosed properties onto the open market at fire sale prices. This created a vicious, deflationary spiral. By flooding the market with cheap, distressed properties, the banks inadvertently drove down the value of all surrounding real estate. As property values plummeted, millions of other homeowners suddenly found themselves underwater, meaning the principal they owed on their balloon mortgage was now greater than the actual market value of their home. When their own short-term loans came due, they simply walked away, triggering even more foreclosures, more dumped properties, and further price collapses. By 1932, the American housing market had entirely ceased to function. The statistics from this era are almost difficult to comprehend. At the height of the crisis, 1,000 homes were being foreclosed on every single day. Nearly half of all residential mortgages in the United States were in a state of default. The construction of new homes plummeted by 95%, devastating the timber, steel, and manufacturing industries that relied on home building. The Hoover administration attempted to stem the bleeding, but their interventions fundamentally misunderstood the nature of the crisis. In 1932, President Herbert Hoover signed the Federal Home Loan Bank Act. This legislation was designed to provide emergency liquidity directly to the lending institutions. The theory was that if the federal government lent cash to the local banks, those banks would then use the money to resume refinancing balloon mortgages for desperate homeowners. The reality was vastly different. The local banks were terrified. When they received federal funds, they did not pass the money down to the consumer. Instead, they hoarded the cash to fortify their own balance sheets against future bank runs. The top-down approach failed entirely to stop the wave of evictions. It became painfully clear that injecting cash into a broken system was not enough. The financial architecture itself, the short-term, interest-only balloon mortgage, was inherently toxic. It was a financial instrument that required perfect economic weather to function, and it became a weapon of mass financial destruction the moment a storm hit. When Franklin D. Roosevelt assumed the presidency in 1933, the banking system was in ruins, and the housing market was functionally dead. His administration recognized that saving American homeownership required a total, unprecedented redesign of the mortgage contract itself. On June 13, 1933, Congress passed the Homeowners Loan Act. This legislation created a radical new federal agency, the Homeowners Loan Corporation, or the HOLC. The HOLC was not designed to regulate banks or provide temporary relief. It was designed to physically remove toxic mortgages from the private banking system and fundamentally change the terms of the debt for the homeowner. The mechanism the HOLC utilized was a massive government-backed debt swap. It was an operation of staggering logistical complexity. The process began when the HOLC approached a distressed local bank that was holding a defaulted, unpayable balloon mortgage. The federal government offered to buy that specific mortgage from the bank. However, the HOLC did not buy these toxic loans with cash. Instead, they offered the bank government-backed bonds in exchange for the mortgage. For the failing local bank, this was an absolute lifeline. They traded a worthless, defaulted piece of paper for a secure, interest-bearing federal bond. This instantly improved the bank's balance sheet, satisfying regulators and calming panicked depositors. Through this massive exchange of paper, the federal government, via the HOLC, suddenly became the direct owner of millions of individual American home mortgages. What the government did next permanently altered the trajectory of American wealth. The HOLC did not demand the balloon payment. Instead, they ripped up the old, toxic contract entirely. In its place, they issued the homeowner a revolutionary new financial product. This new contract was a long-term, fully amortizing loan. To understand the genius of this intervention, we must look closely at the mechanics of amortization. Under the old balloon system, a homeowner paid only the interest, leaving the principal untouched. The HOLC's new amortizing loan stretched the repayment period out over a massive, unprecedented length of time, initially 15 years. More importantly, the monthly payment was mathematically restructured. Every single month, the homeowner's payment covered the interest, but it also paid down a tiny fraction of the principal debt itself. This meant that with every single payment, the homeowner's overall debt shrank. They were slowly, methodically building equity in the property. There was no looming bullet payment. There was no need to constantly beg a local bank for refinancing every 3 years. If the homeowner simply made their steady, predictable monthly payment for 15 years, the debt would organically reach zero. They would own the house free and clear. By stretching the timeline to 15 years and amortizing the principal, the HOLC dramatically lowered the monthly financial burden on the American family. A payment that was impossible to meet under a 3-year balloon structure suddenly became manageable when spread across 180 months. Between 1933 and 1936, the Homeowners Loan Corporation received nearly 2 million applications for help. They ultimately purchased and refinanced over 1 million mortgages, effectively saving 1 out of every 10 owner-occupied homes in the United States from imminent foreclosure. The HOLC proved that a long-term, amortizing mortgage was not only possible, but that it was vastly superior to the unstable balloon loans of the past. It stabilized the housing market and saved countless families from financial ruin. But the HOLC was only intended to be a temporary rescue operation. It was a triage unit designed to stop the bleeding of the Great Depression. By 1936, it stopped accepting new applications and began the long process of managing the loans it had already acquired. The fundamental problem remained. The federal government had proven that the long-term amortizing mortgage was the cure to the housing crisis. But private banks, still deeply scarred by the Depression, absolutely refused to offer this type of loan to the public. Lending money to an average citizen for 15 or 20 years still felt far too risky for a private institution. The government had modeled the perfect financial instrument, but the private, free market refused to adopt it. If the American middle class was ever going to expand, the federal government had to figure out a way to force private banks to issue long-term loans without the government actually buying the mortgages themselves. The architecture of modern American real estate required one more massive, permanent intervention to bridge the gap between government safety and private capital. The fundamental obstacle standing between the American public and mass home ownership was the banking industry's absolute terror of time. In the financial world, time equals risk. Lending money for 3 years was an acceptable gamble, but locking up capital for 20 or 30 years seemed like an invitation to insolvency. To overcome this paralysis, the Roosevelt administration realized they had to completely sever the concept of risk from the act of lending. If the government could somehow guarantee that a bank would never lose money on a mortgage, the banks would eagerly open their vaults. This conceptual breakthrough led to the passage of the National Housing Act in 1934. This monumental piece of legislation created the Federal Housing Administration, universally known today as the FHA. The FHA was a radically different entity than the Homeowners Loan Corporation. The FHA did not lend money to citizens, nor did it buy mortgages from struggling banks. Instead, the FHA functioned entirely as an insurance company. The mechanism it introduced, federal mortgage insurance, is the absolute bedrock of the modern housing market. To understand how this unlocked the 30-year mortgage, we have to look at the precise transaction at the lender's desk. Under the FHA system, a prospective homebuyer would go to a private bank and apply for a long-term, amortizing loan. The bank would agree to issue the funds, but only if the FHA agreed to insure the mortgage. If the FHA approved the application, the borrower was required to pay a small, mandatory insurance premium alongside their monthly mortgage payment. These premiums flowed into a massive Federal Reserve Fund managed by the FHA in Washington. For the local bank, this insurance policy was a golden ticket. It meant that if the borrower lost their job, defaulted on the loan, and the property went into foreclosure, the bank would not suffer a financial loss. The FHA would step in, draw from its massive reserve of premium payments, and reimburse the private bank for the outstanding principal balance. By transferring the ultimate risk of default from the private bank to the federal government, the FHA instantly transformed the mortgage from a high-risk gamble into one of the safest financial instruments on the planet. In exchange for providing this bulletproof federal guarantee, the FHA demanded total control over the terms of the loan. If a bank wanted the safety of FHA insurance, they had to strictly obey the FHA's lending rules. The government dictated that these insured loans must be fully amortizing. They dictated that the interest rates must be capped at a reasonable level. Most importantly, they forced banks to dramatically extend the repayment timeline, initially to 20 years and eventually stretching to the now standard 30 years. Simultaneously, the FHA attacked the insurmountable barrier of the 50% down payment. Because the federal government was absorbing the risk of default, the FHA allowed banks to issue loans to borrowers who could only put down 20% and later as little as 10% of the purchase price. Almost overnight, the mathematics of buying a home changed. By slashing the required down payment and stretching the remaining balance over 2 or 3 decades, the monthly cost of home ownership plummeted. For the first time in American history, paying a mortgage became cheaper than paying rent in a crowded urban apartment. However, this brilliant insurance mechanism created a secondary, highly complex problem regarding liquidity. If a local bank issued a 20-year FHA-insured mortgage, it meant their cash was locked inside that specific house for 2 decades. While the investment was incredibly safe, the bank could not use that money to issue another loan to the next family walking through the door. If millions of Americans suddenly wanted these new 20-year mortgages, local banks would rapidly run out of liquid cash to lend. To solve this liquidity bottleneck, the federal government had to invent an entirely new layer of financial architecture. In 1938, Congress amended the National Housing Act to create the Federal National Mortgage Association. Today, this institution is known globally as Fannie Mae. Fannie Mae was designed to act as a secondary market for mortgages. Its mechanical function was to continuously pump fresh cash into local banks so they could keep making FHA loans. The process operated like a perpetual motion machine of debt. A local bank would issue an FHA-insured mortgage to a family. A few weeks later, Fannie Mae would purchase that exact mortgage from the local bank, paying for it with cash raised by selling government-backed bonds on Wall Street. The local bank suddenly had its cash back, allowing it to instantly issue another long-term mortgage to a new family. Fannie Mae held onto the paper, collecting the steady stream of interest payments over the next 20 or 30 years. This tripartite system, the local bank originating the loan, the FHA insuring against default, and Fannie Mae providing endless liquidity, was the structural engine that built the modern American suburbs. It standardized the 30-year fixed-rate mortgage, transforming it from a mathematical impossibility into a mass-produced consumer product. Yet this unprecedented expansion of federal power required strict bureaucratic standardization. The FHA was putting billions of taxpayer dollars on the line to guarantee these loans. They needed a unified, scientific method to evaluate which properties and which borrowers were actually a safe bet. To achieve this, the agency published a comprehensive document known as the FHA Underwriting Manual. This manual was distributed to thousands of bank appraisers across the country, instructing them exactly how to determine if a home qualified for the miracle of federal mortgage insurance. The manual demanded strict construction standards, ensuring that newly built homes had proper plumbing, ventilation, and structural integrity. But the underwriters were not just evaluating the physical materials of the house. The FHA firmly believed that the long-term financial stability of a mortgage was directly tied to the social and demographic makeup of the surrounding neighborhood. They mandated that appraisers evaluate the people living near the property to determine if the area was at risk of future economic decline. This administrative requirement to assess neighborhood risk would quietly twist the government's greatest wealth-building invention into an instrument of devastating financial exclusion. The 30-year mortgage was finally available, but the federal government was about to draw very strict, color-coded lines dictating exactly who was allowed to sign the paperwork. The FHA Underwriting Manual was not merely a set of suggestions. It was the rigid rulebook governing the flow of billions of dollars in federal credit. And woven directly into the text of this manual was a profound and explicit racial bias. The federal government officially adopted the stance that racial integration inherently destroyed property values. The manual explicitly warned appraisers that if a neighborhood experienced an infiltration of inharmonious racial groups, the financial risk of lending in that area would become unacceptably high. To operationalize this discriminatory theory, the government relied on a series of residential security maps, originally pioneered by the Homeowners Loan Corporation and subsequently adopted and refined by the FHA. These maps categorized every neighborhood in a major American city into 4 distinct grades. The highest grade, colored green, represented new, homogeneous, and exclusively white subdivisions. These areas were deemed the safest possible investment, and FHA insurance flowed into them freely. The lowest grade, colored red, was reserved for neighborhoods deemed hazardous. The defining characteristic of a redline neighborhood was not necessarily the physical condition of the housing stock, but the presence of minority populations, particularly Black Americans. If a neighborhood was drawn in red, the FHA almost categorically refused to insure any mortgages within its borders. The consequences of this bureaucratic decision were immediate and devastating. Because private banks absolutely relied on FHA insurance to mitigate the risk of a 30-year loan, a red line effectively severed an entire community from access to conventional credit. If a Black family wanted to buy a home in a red line neighborhood, they could not secure a modern, amortizing 30-year mortgage. They were forced to rely on predatory, unregulated lending mechanisms, such as contract for deed sales, which often function like the toxic balloon mortgages of the 1920s, offering no equity and constant threat of eviction. Simultaneously, if a Black family attempted to move into a green-lined, newly constructed suburb to access FHA credit, they were blocked. The FHA manual actively encouraged the use of racially restrictive covenants, legally binding clauses written directly into the property deeds that strictly forbade the sale of the home to anyone who was not white. For over 3 decades, the federal government actively subsidized the mass migration of white families into the suburbs, utilizing the 30-year mortgage as the engine of incredible wealth creation. These families paid down their principal, built equity, and eventually passed that accumulated wealth down to their children. During that exact same period, minority communities were systematically denied access to that exact same wealth-building tool. The lines drawn on those government maps starved inner-city neighborhoods of capital, leading to decades of structural disinvestment, declining property values, and profound economic isolation. The Fair Housing Act of 1968 officially outlawed housing discrimination and the overt practice of redlining. However, the architectural damage was already permanently embedded into the landscape of American wealth. The 30-year mortgage is essentially a time machine for capital. It takes decades for a family to realize the full financial benefit of the system. By the time minority families were legally granted equal access to conventional credit, an entire generation of white homeowners had already utilized government-backed mortgages to accumulate massive generational equity. The immense racial wealth gap that persists in the United States today is not merely a product of individual choices or abstract market forces. It is the direct mathematical consequence of who was granted access to the 30-year mortgage between 1934 and 1968 and who was explicitly denied. Today, the 30-year fixed-rate mortgage feels like a natural law of economics, a standard feature of the American dream. We rarely consider that it is, in fact, an entirely artificial construct. It is a highly engineered financial product created by a desperate government to prevent the collapse of capitalism during the Great Depression. It required the invention of federal insurance, the creation of secondary markets like Fannie Mae, and a total restructuring of how society viewed long-term debt. The system succeeded beyond anyone's wildest imagination, transforming the United States into a nation of homeowners and building the most prosperous middle class in human history. Yet that success was predicated on a system of targeted exclusion, proving that when the government redesigns the architecture of wealth, the most crucial decision is always deciding who gets to walk through the door. So consider where you would have stood on those color-coded maps, and whether a system that built unprecedented prosperity can ever be called a success when its foundations were laid on deliberate exclusion. If you want to understand why the world works the way it does, you have to look past the political rhetoric and examine the mechanics of the systems we live under. Subscribe to our channel to uncover the hidden origins of the institutions, laws, and financial structures that dictate our daily lives.